Good morning. I'm Mahini Naidu, Senior Investment Analyst on the Nedgroup Investments Best of Breed team, and it is my absolute pleasure today to welcome Steve Romick, Co-Portfolio Manager of the Nedgroup Investments Global Flexible Fund. Steve will be talking to us about how the fund has fared in what he terms an exceptionally unexceptional year. Steve will also share insights into the challenges facing portfolio managers with a value philosophy and how this impacts the fund's positioning and ability to deliver on its objectives through a full market cycle. Without further ado, welcome, Steve, and over to you.
Thank you very much, Marie. Appreciate it. By way of background for the uninitiated, the fund has always operated with this objective to provide equity rates of return over full market cycles and deliver that with less risk. Key characteristics of this portfolio really that we have great flexibility to invest across the capital structure. And I'll circle back to that, a bit later, because one of the, key legs on that stool have pulled up from under us with respect to the lack of opportunity in high yield and distressed. We do a lot of really good work on our team to really understand what some of the better businesses around the world and what people may not be paying and why people may not be paying the appropriate price for them. And we will then look to position those types of companies in our portfolio. The goal in this portfolio over time is to generate a rate of return, but not forget about protecting the capital. When I say protect capital, I'm really referring to permanent impairments of capital. Sometimes market volatility will get in the way, and we'll circle back to that later as well. If you look at the portfolio today where we sit, at the end of the fourth quarter, we had 72% in equity, which is above our historic average and above where we were a year ago. Our exposures are higher today because our exposure in general for credit and bonds is lower, and we have great concern with what's happening around the globe with respect to the wanton printing of money that at some point will likely render, fiat currencies less valuable. So as a result of that, it creates some greater volatility than we might have historically had in the portfolio, but we can't forget about our need to make money over longer time frames. So that is one significant difference. And the other variable is versus a year ago, and where it's really led to the increase in the exposures in the portfolio, we're really in Q1 and into Q2, where we were taking great advantage of the market swoon and committing a lot of capital to the portfolio. Within the portfolio, I mean. The breakdown in the portfolio, as you can see on this slide, is 43% of the equity, largest portion is in North America, and the balance is outside the United States, in various parts of the world. More important than that is that more than half of the revenues of the companies that we have in our portfolio, well over that, are domiciled or sourced from outside of the United States. This is truly a global portfolio. And it's a global value portfolio. I use the word value hesitantly because value historically has meant, something, is historically been expressed in securities investing as having a protection of the balance sheet. And what has really become more important in the last 20 years is understanding that just because you thought you had protection of a balance sheet, you can't forget about what the business is. Because you could have owned a Sears in the United States, for example, which had tremendous balance sheet perceived protection because of all of the real estate it owned. But as they sold off that real estate and they mortgaged that real estate, to fund its operating business that was in great decline as it was being disintermediated by online, the company's value eroded significantly. So we invest and think of ourselves as value investors, and we invest with a margin of safety. But over the years, the migration, as you think about that margin of safety, has shifted from the value of the balance sheet to the value of the business. And that in and of itself creates some greater volatility. And one has to do the good work to understand what is more likely to succeed over the long term within that portfolio. So one of the good parts about that is you end up good growing businesses. One of the negatives is in this environment with rates as low as they are, it makes it tougher to find, those types of opportunities. And with rates as low as they are, it takes away, some of the opportunities that have existed historically for us in high yield and distress. In addition, because the low rates is they take away the high yield and distress, and that tool, that leg in the stool, as I mentioned earlier, gets taken out from under us. It makes us look more similar to other just long only equity managers. And we do expect and hope that there will be an opportunity in the future, but we don't know when that obviously might be. The performance in the portfolio as we look forward, as we look backwards, sorry, my machine is frozen. As you look at the performance over the 3 months, 1 year, 3 years, and 5 years, you can see that, we have our performance benchmarks in the MSCI World Index. We're behind that, over that time frame, slightly behind it on the 5 years on the versus the performance indicator. But it's important to understand that there's two significant variables that are driving the performance benchmark that you have listed there. One is the index is much more growth tilted, and you've got this global bond index in there that's had a tremendous benefit, of the decline in rates, which has been the biggest driver of stock returns over the last 3 decades. At some point in time, some of this shifts where rates can't go any lower and value does begin to, creep back into the portfolio, to the returns of a portfolio where there's a recognition in the world that price does matter. There's been so much emphasis that has come into the securities markets and having, tremendous growth, that it makes it much more challenging to just be a value investor in this environment. And if you look at in the last year, there is $120 trillion of stock traded hands in the U.S. stock exchanges alone, with the average stock in our Russell 3000 index, a broad index, surging 46% during the course of the year. And the companies that perform best were those with better perceived prospects than current earnings. In fact, we wrote about this in our Q3 commentary. You'll note that at the point in time, and this is through the third quarter, I've not updated, these numbers, through the end of the year, but, through the third quarter, there was a tremendous benefit in the market to those companies that didn't earn money. So I'm looking for a quote, on my desk right now, see if I can find it. But there, at the end of, through the end of Q3 and actually into October, if you had a portfolio comprised of the companies that were losing money and had market caps of greater than $1 billion, so companies that were losing money and had market caps greater than $1 billion, those companies on average were up 65% in the United States. So you've had tremendous momentum that's entered the market. So we have outperformed the market on the world value index. We've outperformed, quite reasonably, particularly in the recent, period. In the last year, with our portfolio, performing 10% versus the world value index declining 1%. As you can see in the last 3 months, the performance of the portfolio had a significant rebound versus, the benchmark. And that's largely because of the capital we put to work in the first quarter and into the second quarter, whereas we pulled down the cash in our portfolio and bought many of these businesses that people had given up, for the dead. Because we believed, as you look across the great chasm that is COVID, we believed that over time we were going to once again travel. Once again, I'll find my way to South Africa to visit our clients there and to England. And we will find that I'll be staying in a hotel and I will be eating in a restaurant, and that will eventually happen. And yet the stock market valued many of these businesses as if it wasn't going to happen again in the future. So we were able to take advantage of that opportunity set, and we saw a great rebound in the fourth quarter as it continued into the first quarter as well. As you can look at the performance contribution, you can see this tale of two worlds. Look at the trailing 12 months. The quarter to date, there wasn't much by way to detractors. We tend to want you to focus on the longer time frames anyway. But, it's interesting as you look at the trailing 12 months, you look at the left-hand side of this table, you will see largely technology companies, which has been the biggest driver in the market. And that's been a great driver of return. So we bought these companies. We didn't just jump into Google, Alphabet, as it's known, recently. We've owned it since 2011 when globally there's fear of economic downturn, and Cyprus was going to, disappear back under the ocean, and the EU is potentially going to unwind as a group, and as a result, there was great fears of what's going to happen to advertising, and Google became an opportunity, and we purchased it back in 2011 and held it ever since. But a lot of what you see is driving us. We buy these companies when they're out of favor, and they don't offer the same attractive opportunities on a risk reward basis, at today's market in general. And that's why some of these, and Mahaney asked this question earlier, some of these companies within our portfolio, we've reduced exposure to some of these more expensive businesses. And so Microsoft, for example, is no longer in the portfolio. The companies that have not performed as well, are the companies that are more traditional value, investments. Howmet Aerospace, again, we think people are going to fly again. We still maintain, the exposure, to that company. Ally Financial, is another example in the portfolio. Financials, we have a fair number of financials in the portfolio as well. So we are very sensitive to price, and the price does matter to our portfolio. And we're not looking to be a man for all seasons. We're looking to be a man for all seasons, not just one season, as the phrase goes. By way of market commentary, there's no great surprise to anybody that growth has been the driver. The ACWI growth grew 34% and dominated the ACWI index. The S&P 500 growth grew similarly, but far greater than the indices, on their own, and way ahead of where the value indices have performed. If you look at the far right-hand side of this chart, where the S&P 500 value was only marginally positive in 2020, and the MSCI ACWI value was solidly negative. Long-term equity returns, are achieved with significant variability around the mean. If you look at the end of returns going back, over time, this is why we call this past year an exceptionally, unexceptional year. The MSCI ACWI index has returned 6% over the past 22 years, but in only 2 instances were the returns even within 2% of the average. You can see how it's moved up and down around this average quite dramatically. In 68% of the cases, the returns were more than 10 percentage points higher or lower than the average, with a 69% spread between the best and worst years, and with 26.7%, being the best year in 2019 and a loss of 42% in 2008. Therefore, as it relates to stock market returns, 2020 was truly an exceptionally unexceptional year, but with great variability within that year. And that's what, created some opportunity for us along the way. And we still see, and you can see earlier in the year, you see this gap in this chart. And this chart reflects the cheapest portion of the market versus the most expensive portion of the market. So the cheapest quintile compared to the market average, over time. So as this line goes higher, there's greater variability between what is inexpensive and what is expensive. And you can see earlier this year that number had peaked out. And you always have seen every point in time in the past, as this line, increases, our exposures increase. As it goes down, our portfolio decreases. At this point in time, you still see many stocks that are trading inexpensively, and we still think there's gas left in the tank in our portfolio companies, some of the financials, including AIG, which we've owned for some time, and don't understand why the stock even trades where it does. One of the drivers of performance earlier this year, as just concerning as it might be, when AIG started the year at around $50, went up 10% during at some point during the first quarter, then declined precipitously. In latter parts of Q1, all the way down, in late March to intraday under $17 a share. That's a pretty dramatic decline. Since then, the stock has increased and is back up, to $40 and change. So the stock never should have been, in our view, $17, $18. Shouldn't have been 20, 25. And we would argue that $40 thereabouts today is not the appropriate number. It's still trading below its tangible book value for a business that is I don't want to argue that it's a great business, but it's a very good business that, as it ensures, on the health side, people in the United States and globally on the property and casualty side. And that business is a good management team that is really, we believe, turned the corner and driving the economics of that business to such improvement that we should continue to recognize improvement. We've been involved in this company for a number of years, and it's good to see this management team, really finally beginning to execute. Our cost basis is far lower than, where it's currently trading when we first got involved in this company, over a decade ago. Many of the stocks that have been working in the market have been those at the expense of those that have not been working. So the U.S. large capitalization stocks and their trailing earnings yield, you can see that the difference between the highest and lowest beta stocks, where the higher beta stocks have been the better performing stocks. The companies that have the lower, earnings yield, the inverse of the PE, have been, the better performing. So price, as I said, hasn't mattered. And again, going back to that earlier statement, where the best performing stocks were those companies that didn't earn any money. They were the businesses that people expected or perceive will do very, very well in the future. And the individual investors have just come back in droves, to the market and have driven margin debt in the United States to a high, and options, to a high, with the likes of Robinhood, which is a U.S. organization that allows commissionless trading for individuals. And people are out there, rapidly, transacting or even holding businesses. I don't want to suggest they're just day traders, because they believe they're going to do great in the future, that Tesla will continue to go up and Zoom will continue to go up. And we continue to make the argument that price does matter. And it doesn't mean when we say that price matters, doesn't mean we look across our portfolio, we do not seek to own businesses that are secularly challenged. We don't own the bricks and mortar retailer that they're going to be disintermediated by online. We don't own the mall real estate. We own businesses that are growing business. Now, they may not be growing at the same clip as some of these technology companies, but their values, for the growth that we're receiving are much more attractive. So at some point, the headwinds that have existed in the market over the last decade, for our style of investing, which is more value hewing, where price does matter, maybe that flips around. At a point in time in the future, low volatility stocks end up actually outperforming the high volatility. The United States, which has outperformed international at some point, that begins to offset and begin to exhibit, greater, people become more attracted to what is overseas versus the United States. We think that high yield hopefully will offer a window of opportunity in the portfolio. We made some investments in the cruise industry through high yield, earlier this year. And, interest rates will at some point in time not be as low as they have been. They've upped themselves more recently. And low interest rates are a great benefit to the growth stock. A company that grows out into the future, is expected to grow out into the future, although not earning money today, that might or is expected to earn money 5 years or 10 years from now. The value of that earning stream discounted back to today at a low grade is much, much more valuable than a company that's delivering those earnings in the here and now. So a growth company is a longer duration, a longer duration asset that will be more affected by interest rates, with cash flows further out into the future than what you have today. We expect that some portion of these, some combination of these, will at some point in time flip around in the future. When that might be, we know some of that did shift in Q4 of 2020, and some of that has again shifted, continued that shift in Q1 thus far. It's obviously too early, and one quarter does not a trend make. We'll see what happens in the future, but we'll continue to deliver what we've always delivered, which is a sensitivity to buying good businesses and protecting capital along the way.